behalf of Boston Tax Institute, I'd like to welcome you to our program called Purchase and Sale of a Corporate Business after TCJA. My name is Lou Gauthier, and I'm still a practicing tax attorney, and I've been consulting in this area on various issues, and I'll share some of that with you today. So we're on page 1, preparing for the big score. You can ask yourself, what is the big score? For people in business, I think it's or people going into business, building up a business, and then eventually selling the business for a big price. For some people that are not in business, I suppose buying a home, seeing it appreciate over 20 or 30 or 40 years, and then selling it at a large gain is also a big score, but we're not talking about that today. We're talking about selling a corporate business. So what are your exit alternatives if you have a business? Well, if you're, depending on the size of the business and its profitability, I guess, maybe an initial public offering, but that's not in the cards for most of our clientele. Continued family ownership, somebody could take over the business and continue to run it, and that would be great if they can. Sometimes they can't, and sometimes they're not interested in doing it. Sale to an unrelated third party, management, sale to an ESOP, S stock after 12/31/94 might be a possibility, although management oftentimes lacks the resources to purchase the business. Conversion to personal holding company status. Conversion to personal holding company status. I just want to comment on that for a couple of minutes. If you still represent a C corporation, and the C corporation winds up selling assets, and it's sitting on a chunk of cash after the sale of the assets, you have essentially, well, you'd like to think you have 3 choices. Your choice would be to either liquidate the C corp, but if you do that, you're going to trigger gain at the shareholder level, and that gain could be taxed at a maximum 20% rate, long-term capital gain on C stock, but also attract a 3.8% tax on net investment income. You could, if you choose not to liquidate and you're sitting on cash and you're going to invest that stock cash, typically what you do is you want to invest that stock in high dividend yielding securities. So you become a personal holding company, but you use the dividend received deduction at the corporate level to mitigate the tax at the corporate level. But you then have to compute your undistributed personal holding company income, and you pass that out to the C shareholders. And just yesterday and today, I consulted with somebody that has a personal holding company. So they're still around. It was not a Massachusetts personal holding company. It was in another state. Massachusetts has a separate classification, by the way, for personal holding companies. They call them domestic security corporations. And I believe you still have to apply for that at the end of the year. And of course, the only thing that a Massachusetts securities corporation can invest in is securities. Otherwise, it'll lose its classification. And the advantage of being a Massachusetts security corporation is that its gross income is taxed at a 1.32% rate, as opposed to its net income being taxed at the mass tax rate, the mass corporate tax rate of 8%. And usually in a security corporation, you don't have much by way of expenses, so your gross income is often pretty much equal to your net income. So by being a mass security corporation, you're cutting your tax rate from 8% to 1.32%. If you're gonna try to run your C corp as a personal holding company, then you really should think about mass security classification, and I believe you still have to apply for that before the end of the year. I haven't done that in a very long while, but I believe that's how it still works. And as I said, one of your choices after a C corp were to sell assets, let's suppose, is to completely liquidate. But if the C corp completely liquidates and passes out cash, that's going to trigger gain on the C stock. So a lot of people, the reason why they continue to be a personal holding company is to avoid, let's say, the 20, possibly maximum rate of 20% on the C stock, plus 5% in Massachusetts, plus don't forget the 3.8% tax on the gain on C stock.